Hello, my friends. Today is March 30th. Happy Easter weekend. This is Markets Weekly. So, this week was a pretty quiet week in markets. We only had 4 trading sessions. But the S&P 500 did manage to make a new all-time high. From my perspective, though, it looks like the Nasdaq is running out of momentum. So, it would not surprise me if we just kind of, consolidated here for a little bit and gave other people the chance to join the party. So today I want to talk about 3 things. First, I want to talk about the tremendous challenge facing Japanese policymakers because it looks like they're about to lose control of the Japanese yen. Secondly, I want to talk a little bit about this new research from the Federal Reserve Bank of San Francisco that sheds interesting light on the surge in early retirements during the pandemic. And lastly, I want to discuss hyperinflation during revolutionary France and what we could learn from it. Okay, starting with the yen. Now, just to level set a little bit, over the past few years, the Japanese yen has depreciated significantly against all major currencies. And the reason for the depreciation is obvious. Now, over the past few years, all the major central banks were raising rates aggressively to try to combat inflation, while Japan kept its interest rates negative and only recently hiked them to 0. So this huge interest rate differential drove a rapid depreciation of the Japanese yen. You can think of it as maybe you're a Japanese investor. You're seeing that you're getting 0 interest rates at home. You could get 5% in the US, so you sell yen, buy dollar assets. Or you could be a foreign speculator and funding your investments in yen. In any case, the Japanese USD JPY exchange rate right now is bumping up against 150, 151, which over the past few years has seemed to be a soft ceiling. Now, when you're in this situation as a policymaker, you have 3 options. First, you can do verbal intervention and try to talk the speculators down. Secondly, you can actually intervene, so actively sell foreign currency and buy your domestic currency. Or 3, you could adjust the stance of monetary policy and make it less attractive for speculators to sell your currency. Now, over the past week, we've seen Japan come out and do some serious verbal intervention. Their top currency official is going around saying that he thinks that the depreciation in the yen is not driven by fundamentals, but into speculation. He doesn't like it. He wants it to stop. Now, over the past few years, I think they were happy with the depreciation in the yen because it helped them get inflation up by increasing imported costs. And of course, it was also good for exporters. But it looks like depreciation has gone too far for them, and so they're trying to talk it down. Now, I'm not sure what fundamentals the policymaker is looking at, but if you look at, say, even real interest rate differentials, it does seem to justify a weaker yen. But in any case, it doesn't seem to be working because it looks like USD JPY is still hovering around that 150 soft ceiling. Now, the second thing a policymaker could do is to actually intervene. So they would have to go use their foreign reserves, sell them, and buy back their domestic currency. So Japan is a country with a major current account surplus, so they've accumulated tremendous amounts of foreign reserves. According to official filings, Japan has about $1.1 trillion in foreign reserves. Not all of it is going to be in dollars. As a major trading nation, I'm sure they have reserves in euro and RMB and other currencies as well. But I'm guessing, let's say, the bulk of it is. So maybe they have, say, $700 billion of that is in US dollars. So they definitely have the firepower to intervene if they want. But here's the problem with that. Now, they actually already intervened in late 2022 when USD JPY was pushing against 150. And their intervention led to the yen to strengthen significantly, but now we're back here at 150. So it looks like the dips in USD JPY just get shallower and shallower. The market, it doesn't seem to be as effective, and the market seems to be less scared. What they would do if they were to intervene is they would probably burn, let's say, tens of billions of dollars, and they would buy time. And maybe, in a few months, maybe the US gets some soft data, market prices in more Fed cuts, and maybe the yen gets some reprieve. But then again, maybe that doesn't happen. So it's not super clear if that's the best course of action. The last thing a policymaker could do is they could adjust the stance of monetary policy. So in this case, that would be to hike interest rates, let's say to 50 basis points or even 100, and narrow the interest rate differential from their side. Now, this would go some ways towards making it less attractive to short the yen. But again, even if you hike it by 50 basis points, I don't know. The interest rate differential is still quite wide. And also, Japan has been struggling with disinflation for some time. I'm not sure they want to have such an aggressive hiking cycle. So that seems very unlikely to me. Their best bet is, probably just to intervene and hope for the best. But if they don't do that, though, if the market breaks through this soft ceiling of, say, 150, 151, you could easily have momentum build and have some surges to the upside. So I think they are in a kind of a tricky position now, and it's going to have to get resolved really soon. So they're going to have to put up or shut up. Okay, the second thing I want to talk about is this brand new research from the Federal Reserve Bank of San Francisco that shed some interesting light on the surge in early retirements we saw during the pandemic. So to level set a little bit, during the pandemic, of course, everything shut down. Everyone stayed at home. Labor force participation dropped significantly across all age cohorts. But as the economy opened up again, a lot of people went back to work. Basically, everyone went back to work except those age 55 and above. Labor force participation for those age 55 and above dropped during the pandemic and just never recovered. Now, this led to basically a shortage of labor. Compared to pre-pandemic estimates, the labor force was smaller by 2 million people, and that shortage of labor was part of the reason behind the labor scarcity and surging wages. Now, this new data from the Federal Reserve Bank of San Francisco further breaks down that cohort of 55 plus and has an interesting finding. That is, the thing that stood out was that there was a series break in that there's a structural shift in behavior for those aged 55 and above without college degrees. So the unexpected surge in early retirements really just comes down to this cohort of people aged 55 and above without college degrees. And, that's kind of a puzzle here. It could be of health concerns. It could be maybe they, just had enough savings, had enough wealth. It's not super clear, and I think that's more of a sociology question. But I also think that it relates to other issues. So if you are someone who's 55 and above without a college degree, you're probably in the trades. Maybe you are a truck driver, maybe you are a plumber, something like that. And that goes a long way in explaining all the anecdotal reports we've been hearing around that time where it was very difficult to find someone to come and, basically do more manual labor. It seems like that was founded upon this huge surge in early retirements. Now, as a corollary to that, it seems like a part of the reason why things seem to have gotten better could be because we have such a huge surge in low-skilled immigrants over the past year. Now, the CBO estimates that immigration last year was about 3.3 million, most of it illegal. Now, we do have some interesting studies on the skills competition of these people, and as we hear, they're not really sending their best. They're not college grads. It seems like more like middle school in Spanish. So, but these guys are probably able to do a lot of the labor-intensive jobs that we seem to need to be done. And so that might go long ways in explaining, I guess, the disinflationary trend we've seen in wages, which continue to be high, but are no longer accelerating and seem to be gradually decelerating. One other thing that I'll note is that, so if you have a surge in the supply of labor to try to tamp down on labor inflation, that's great when you have a lot of demand, but ultimately one day when demand falters and you continue to increase the supply of labor, and Sid Pradu on Twitter made this good point, then you'll just have higher unemployment rates, which of course would argue from the Fed's perspective for easier monetary policy. So there's a lot of things happening in demographics right now that might be making these models that people usually rely on to be less reliable. Okay, the last thing I want to talk about is hyperinflation in revolutionary France. Now, this topic came to me by looking at a post by Cuppy that featured writings by Eric. Now, Eric, I had heard him recently on the Market Huddle podcast. He had managed African portfolio for a number of years, and he was discussing his experience with hyperinflation in Zimbabwe. But he also then posted this article about hyperinflation in during the time of revolutionary France. So let's say 1780s, 1790s. I thought this was fascinating, so I went and dug a little bit deeper, looking at some research by Professor Andrew White of Cornell University written in 1912, and also some recent podcasts on the subject on Macro Musings, where you had two scholars looking at this from a monetary policy perspective. I thought it was so interesting that I just had to talk about it. So, the hyperinflation in revolutionary France was ultimately a fiscal problem. At that time, France was highly indebted, so much indebted that about 15% of government revenues went to pay interest. So, obviously, that was unsustainable. So, what did the policymakers decide to do? Well, they decided to create a new currency called the assignat, which they would use to pay off their debts. Now, of course, they're not just going to create money out of thin air, so they wanted to make people have confidence in their new currency and decided to back it by real estate. So back then, you had different power centers in France. You had the aristocracy, you had the crown, you had the clergy, and the clergy was just not as powerful, and so everyone decided to confiscate their lands, and they were the largest landholders in France. Just confiscate their lands and issue assignats against them. The way this would work is that they would pay off their debts with this newly issued currency, and then they could sell the clergy's land, but only accept payments in either gold or assignats. So this link between, say, real estate and gold and assignats was able to give confidence in the value of this newly printed currency. Now, first, they printed $400 million worth of it. And then, a few months later, the government ran into trouble, remembered what a great idea it was to print assignats, and they printed 800 million. And later on, they printed more. But they were realizing that this was getting out of hand, and they would promise everyone, no, this is the last time we'll do this. We won't do this anymore. But they would promise that, and a few months later, they would print more again. When all is said and done, by 1797, they would have printed $45 billion worth of assignats. And as you can see, the price of assignats against gold basically crumpled, such that by the end of 1797, they were worth nothing and ultimately canceled. Now, I thought, okay, well, first of all, that's what happened. But let's talk a little bit about the economic and socio-political implications of this. So, by and large, the first issuance of 400 million was very positive. Everyone was happy. All this money went through the system. People felt richer. People were buying. Economic growth was good. Everyone felt richer. But that seemed to be temporary, and soon after, that sudden surge would fade. And subsequent printings of assignats didn't seem to have the same impact. In fact, later on, the more they printed, you didn't actually get that surge in economic growth anymore. All you got was inflation. And that had some interesting qualities to it. Now, when prices began to rise, a lot of the businesses and so forth, they felt unsure about what was going on in the economy. So they began to have less investment. They began to be more cautious, and that also meant that there was less demand for labor. And so ultimately what you ended up was some kind of economic stagnation with rising prices. And the people at the time, they were complaining that everything was expensive, they couldn't buy anything, there wasn't enough money, and so they would complain to the government, who in turn would respond by just printing more money, which never seemed to solve the problem. Now, at that time, I think it's worth noting that, all the talking heads, all the luminaries, all the newspapers would go around telling people that, actually inflation is a good thing. It's good for business. Or when people were unhappy about inflation, they would tell them that, this is because you have all these people from England who are counterfeiting the currency, those bad foreigners, which actually did actually happen. But they would also point to things like, these greedy rich people, bad government, and so forth. But they would never actually talk about the root cause, which was they were just issuing too much currency. And as times became tough, the government would roll out all sorts of measures to try to contain this. They would go towards traditional measures, say price controls, which is, of course, what every government does in response to inflation, that would try to control, let's say basic necessities cannot exceed this price. If you are a merchant, you can only make this much profit, or if you are shipping stuff, you can only have this much, charge this much per mile, and so forth. And these price controls really didn't seem to make things better. In fact, because the price control levels were set so far below market, many merchants simply couldn't make a profit and just stop doing business. Now, through this period, what I found was most interesting was that basically the price of everything from real estate to basic necessities and stocks all crashed up. Everything except the price of labor. Because as business stagnated, there was just less demand for labor, basic supply and demand, that kept wages low, such that wages basically were unchanged during the period, even as the price of everything soared, and a lot of the working class ended up having to live on government rations. So at the end of the day, at the end of the period, everyone suffered. The laborers suffered, the merchant class suffered, and even the rich suffered as well. The only people who really did well during this period were the speculators. Now, the speculators, those who were a bit more savvy, understood what was happening, and they began to buy all sorts of real assets, stocks or real estate, and so forth, and they made out like bandits. And in this time period, since the only people who did well were the speculators, everyone took to speculating because that was how you would make your fortune. People stopped believing in working hard, stopped believing in thrift. They just went out and speculated because that was how you could make it. Ultimately, of course, this all became unsustainable, crashed down, and ultimately was fixed when people lost confidence in the government and Napoleon took over. Now, I say this not because I think hyperinflation or anything like that is going to happen here, but I think it's interesting to note that when you have significant, let's say, mismanaged fiscal policy, at the end of the day, you will get inflation. You will get inflation in asset prices. And at the end of the day, I think it's the ordinary people who will suffer the most unless they are aware of what's happening and then they could protect themselves. And we are early in this process, but it's just something to keep in mind. This is something that happens over and over again in history. All right, that's all I prepared for today. Thanks so much for tuning in. If you're interested in my thoughts, check my blog out at fedguy.com, where I post weekly commentary. And of course, check out my courses at Central Banking 101 if you want to learn more about financial markets. Talk to you all soon.